So welcome to this video. In this video, we are going to discuss about business valuation. So these are the topics that we are going to see in this video. We are going to start with the discussion about valuation of equity shares and the various methods. So asset-based method, PE method, earnings yield method, dividend-based method, discounted cash flow based method, valuation of preference shares, valuation of debt, valuation of irredeemable debt, redeemable debt, and convertible debt. So these are the topics we will be discussing. So we'll start with the valuation of equity shares. So we'll start with the market capitalization or MCAP. So the market capitalization is a general application where it might come around in any type of equity valuation. So have a general understanding about the market capitalization. So it refers to the current share price of a company multiplied by the total number of shares in issue. So we'll be discussing about net asset value method. So net asset value method equals to take the total asset of the company, so the balance sheet total, deduct the goodwill and deduct all total external liabilities. So total external liabilities will include both long-term liability as well as current liability. So deduct both. So once you have got the net asset value, what you can also find out the net asset value per share. So you take the NAV divided by the number of equity share, you will get NAV per share. So we will start from this problem. The following is an abridged version of the statement of financial position of contractor scope, an unquoted company. So this company is not trading in the market as at 30th April 2006. So it says the non-current asset, that is a book value, is 4,50,000. Net current assets is 1 lakh, and the company has $1 ordinary shares which are worth 2 lakh rupees. Reserves are 2 lakh 50 and loan notes are 1 lakh. So these are the balance sheet items, and they also tell you loan notes are redeemable at a 2% premium. So the loan notes can be redeemed at 2% premium. The current market value of freehold property exceeds by 30,000. So the freehold property would be in the non-current asset. So in the non-current asset, you can add another 30,000 because the value of the freehold property is exceeding the book value. Book value is this number 4,50,000. So the actual non-current asset value should be 4,80,000. All assets other than property are estimated to be realizable at their book value. So any other asset, any other asset is the net asset, net current assets that can be realized at the book value itself. He's asking you calculate what is the value of an 80% holding of ordinary shares on an asset basis. Okay, so on an asset basis is the asset based valuation method that he is asking. So we'll start. So we'll start with the non-current asset. So the non-current asset value is 4,50,000, which is existing there. That has to be added with another 30,000. So that comes to 4,80,000. So all other assets, we can take it as the current assets. The current assets is realized at their book value. So the total assets of the company, is 5,80,000. So we have to deduct all the total liabilities. So total liabilities refers to the current liability and the long-term liability. So here we have the loan. This is a long-term liability. So it is realizable. So it can be redeemed at a 2% premium. That's what they say here. So at a 2% premium. So if it's 100 is the book value, 2% is the premium. So we can redeem it at 1,02,000. So the total value comes to 4,78,000. So this is the NAV. The question asks you not the total NAV but a 80% holding. So 80% value based on NAV is equal to 4,78,000 into 80%. So we'll get the value. So we get 3,82,400. So that's about the value, and this is like represented in the dollar terms. So we have another problem here. The owners of private company wish to dispose of their entire investment in the company. The company has issued 1 million 0.5 nominal shares. The owners have made the following valuation of the company's assets and liabilities. The non-current asset at book value, it comes to 30 million. The current asset comes to 18 million. The non-current liabilities come to 12 million, and current liabilities come to 10 million. So they say that the net realizable value of non-current assets, so this one, exceeds by 4 million. So it means that add another 4 million here. The current asset includes 2 million of accounts receivable, which are thought to be irrecoverable. So that value is not going to be realized. So you can deduct 2 million. What is the minimum price which the owner should accept? So whenever they ask you the minimum price, they are asking you the NAV value. Okay. So we'll start from this problem. Non-current asset value. So the non-current asset value is 30 million plus the 4, so that comes to 34 million. Then we'll add the current asset. The current asset comes to 18 million. From there we can deduct the 2 million which is not realizable, so that comes to 16. We'll deduct the non-current liability. So non-current liability comes to 12, that will deduct. Also we'll deduct the current liability. So we'll get the answer. So the total value comes to 28, but this NAV value is a total value. So the question asks you per share value. So what we have to do is we have to find out the total number of shares. So the number of shares in the company is the company has 1 million worth of shares. So we'll take it that as a numerator, divided by each share is worth 0.5 of nominal value. So that means the company has 2 million of shares. So now we'll find out the NAV per share. So the NAV per share will be 28 million divided by 2 million shares. So that gives us 14 per share worth of NAV. So that is about this sum. We'll move on to the next sum. So the next method is called as price earnings method. The PE ratios are quoted for all listed companies and calculated as follows. So your PE ratio works like this: market price per share divided by earnings per share. So if you are not able to get these numbers, you can also use another set of numbers to value. For example, you can use market capitalization of company divided by total earnings. You can use this as a substitute formula. If you don't have data available for this, okay, try to find out whether you have data for this, and you can work it out. So how can we value a company? With the PE method, this can be then used to value shares in unquoted companies. So the value of an unquoted company is equals to the total earnings of that company multiplied by the PE ratio of a quoted company. So the value per share will be EPS into PE ratio. So if you want a per share value, the formula is EPS into PE ratio. If you want the total value of a company, it is total earnings into PE ratio. Okay. So using an adjusted PE multiple from a similar quoted company or industry average. So what is a adjusted PE is? So once you have got a PE number of a quoted company, that cannot be used directly. So if the PE multiple of a quoted company is something like 10, we can't use that. We have to use for an unquoted company. For an unquoted company, we can take this 10, but we have to take an adjustment something like 80% or 70%. So we can take 7x or 7 PE for the valuation of a unquoted company. So that's how it works. It's very simple in terms of working out the problem. We'll start with the problem. So we have a problem here. You are given the following information regarding Accrington Co., an unquoted company. Okay, so it's not being traded in the market. You are required to value 2 lakh shares in Accrington Co. on a PE basis. The total number of shares issued is 4 lakh shares at 25 cents. So the number of shares is given, not the value. Extract from the profit or loss account for the year ended 31 July 2004. So they have given you this data. The P ratio applicable to a similar business suitable for an unquoted company. So this P ratio is suitable for an unquoted company. So we don't need to adjust it. It has already been adjusted. So the PBT is 2,60,000. Corporation tax is given. PAT is given. Preference dividend, ordinary dividend, and retained profit for the year is given. Okay. So we have to value what is the value for 2 lakh shares. First we will value the entire company, then we will find out the value for 2 lakh shares. Okay, so total value of the company. So if you take the PE method, we have two ways to find it out. Either we can find it out through current market price divided by EPS. That's one way of doing it. As these numbers are not available here, or it's like difficult to find it out, what we'll do, we'll use another method. Total value of the company divided by total earnings. So we can take this as a formula and we'll try to solve it. So what are the numbers we have? We know the PE is 12.5. Total value we don't know, but we have to get the total earnings. So which is the total earnings? See, the total earnings is for the equity holder. Okay, so that is what we are trying to find out. So the total earnings refers here to the profit after tax deducting the preference dividend. So 1,40,000 is for both the preference shareholder and the ordinary shareholder. But when you deduct the 20,000, the remaining 1,20,000 is only for the equity shareholder. So we'll solve the balance problem here. 12.5 into this number will go here. So it becomes 1,20,000. So that will be the total value of the company. So that comes to, so the total value comes to 1.5 million or 15 lakhs. So we don't need to find out the total value. What they want in the problem is value of 2 lakh shares. So that's what they want. So we'll work it out that. So this 15 million is for how many shares? This is for 4 lakh shares because that's the total number of shares in the company. We want only for 2 lakh shares. So we'll solve it. So proportionately it should be 7,50,000. Okay. So that is about this problem. The key element in this problem is the PE is already adjusted, so you don't need to adjust it by another 80% or anything and then get a adjusted PE. That is not required because already it is done. And two, what is the earnings for that is to be used in the PE ratio? The earnings to be used is profit after taxation less preference dividend. So that is a concept that you have to take. So we'll move on to the next method. So the next method is called as earnings yield method. The earnings yield method is simply the inverse of PE ratio. So if you know the PE ratio, then earnings yield will be like this. 1 divided by PE is the earnings yield ratio. Earnings yield equals to EPS divided by MPS. It can therefore be used to value shares or market cap of a company in the same way as a PE ratio. So the market value of a company is, you can work out like this, get the total earnings of this company, okay, or an unquoted company, and divided by the earnings yield of a quoted company. So this should be for a unquoted company, and this should be for a quoted company. So if you get these numbers, then you can easily find out the answer. We can incorporate earnings growth into this method similar to dividend growth model. Okay, so you can also add the G here. For example, if you take the dividend growth model that we'll see later, the formula works like this. So the same approach can be used here. Earnings into 1 plus G divided by EY minus G. So if there's going to be earnings growth given in the problem, then you have to use this formula. Earnings is not something like very new or a new formula. It's the same, this formula. So we just add the growth. For example, you have the total earnings, okay, divided by earnings yield. So that will give you the value of a company. So you just add 1 plus G here and you deduct the G here. So you'll get the value of the company, including the growth. Okay. So it's not a new formula. It's the same existing formula. So we'll go to the problem. So here they say that earnings yield based equity valuation we have to do. A company A has earnings of 3 lakh. A listed company has an earnings yield of 12.5. Okay. So there is a listed company whose earnings yield is 12.5. But company A, I think they should be an unquoted company. So they are an unquoted company and we have to value them. So we'll start from that. So we'll start from company A. So value of company A equals to total earnings, okay, of unquoted divided by earnings yield of quoted, okay, for quoted company. So the total earnings of unquoted company is 3 lakhs divided by the earnings yield of the company, of the listed company or a quoted company, is 12.5%. So we'll arrive at the value. So that comes to 2.4 million or 24 lakhs worth. So we have another company here that is called as company B. So the value of company B. So the company B has earnings of 4,20,500, and a similar company, a similar listed company, has a PE ratio of 7. So how do we use a PE method to value? So to value using PE method, we'll have the formula. So the formula is what? The formula is PE equals to total value, okay, total value divided by total earnings. So that's the formula. We'll substitute the numbers. P is 7. Total value is what we have to find. And total earnings is 4,20,500. So if you work out the total value, so the total value should be 4,20,500 into the 7 PE. So the value comes to 29,43,500. Okay, so that's how it's being valued. So again, we are not taking an adjusted PE here. Okay, we are not taking an adjusted PE where the PE will be like multiplied by 80% and we get a lower PE to value an unquoted company, because we are just assuming that this P has already been adjusted. So that's why we are not taking. Okay. So the question will specify whether it's an adjusted PE or a not adjusted PE. If it's an adjusted PE, you can take the number as it is, like how we did it here. If it is a not adjusted PE, you have to take this 80% adjustment, so 80 or 70% adjustment. So adjustment will work like this. Here it will be like 70% or 80%, any number that will specify it in the question. So multiply this and the value goes much more lower. Okay, so that is how it has been like worked out. We'll go to the next problem. So we'll start from dividend based methods. So dividend valuation method is the name of this method, and here the dividend is assumed to be constant. It's not going to change from year to year. In that case, the valuation of a company is P0, the value of a company equals to dividend by KE. So we don't have any problem for this. So we'll move on to the next method, which is usually asked in the exam. We'll start with this method. It's called as dividend valuation method, where assuming dividend is going to grow at a fixed rate, the formula works like this. The P0 or the value of a company is equals to D01 plus G divided by KE minus G. So this is the set of formula. Okay. Here the G refers to the constant growth rate in dividends. The D0 here refers to dividend received today. So or today or this year. Okay, this year. So any dividend that you are going to receive today or this year is referred to D0, and the formula can also express like this. Okay, D1 divided by KE minus G. D1 is represented like this. D1 is next year dividend. So you take the current year dividend D0, multiply it by 1 plus G, the growth rate in dividend, you will get the D1. So if your numerator can either be D1 or it can be D01 plus G. Either of it is like just fine. So whether you are going to use D1 or D0 as a numerator, it can either be a dividend per share or a total dividend. If you use dividend per share as the numerator, then the value that you get is the value per share, because you have used dividend per share, you will get value per share. If you are going to use total dividend in the numerator, then the value that you are going to get is the total value of the company. Okay, so ensure that you understand these basic concepts so that it's easier when you do a problem. So we have a problem here. A company has the following financial information available. So the share capital in issue is, there are totally 4 million shares which are worth 50 cents. So they have given you the total number of shares. Current dividend per share, okay, current dividend per share is 24 cents. So current dividend per share is D0. Dividends 4 years ago is 15.25 cents. The current equity beta is 0.8 and the current market return is 15% and RF is 8%. So when you look at this formula, you will find out that they have given you the CAPM elements and they have also given you dividend valuation elements. Why have they done it both? We'll just look at it now. If you are going to use DVM method, so the value of a company is expressed like this: D0 1 plus G divided by KE minus G. So we'll look at like what are the numbers that we have. So the numbers that we have are, we have D0 which is 24 cents. If we use 24 cents, then what we get is the value per share. We won't get the total value, company's value, we'll only get the value per share. Okay, into 1 plus G. Do we have 1 plus G? G, we don't have it, so we have to find out the G. So this itself is a question mark here. Divided by KE minus G. So KE is not given the question, so we have to find it out. G is also not given, we have to find it out. So what happens is, we have to find out both the G and the KE. So we'll find the G. So G is dividend growth rate. So how can we find out the dividend growth rate? See, the key is in these numbers. They are giving you the value of dividend today and the value of dividend 4 years ago. That it means that they are asking you to find out the G through the compounded growth rate method. So the latest number divided by the oldest number to the power of n, okay, minus 1 and into 100. This is how we have to find out. So the G will be n. N is how many years it is compounded? 4 years ago they have told. So take 4 here. What is the latest dividend? The latest dividend is 24 cents. The oldest dividend is 15.25 cents. Okay, minus 1 into 100, 1.5737. So we'll take a root. So the answer comes to 1.12 minus 1 into 100. So that means the answer is 0.2 into 100. So the answer should be 12%. Okay. So the growth in dividend is 12%. So how did we take this root? To take this root in a scientific calculator, these are the steps that you have to follow. So step number 1, press the number 4. Okay. Step 2 is press shift. Okay. Step number 3, there's a symbol which is like this, the power symbol. Press that, and once you have pressed that, press the number. So the number is 1.5737, and finally press equal button. You will get the answer like this. Okay, you'll get this answer. So from there you can do these steps and you'll get the answer. So as per our problem, our G is 12%. So now we have to find out the KE. So we have to find out the KE. So how we will find out the KE? All information for KE is given here. For example, to find out KE through CAPM method, KE is equals to RF plus beta RM minus RF. So this is the formula. So our RF is 8%, our beta is 0.8, our RM is 15, and RF is again 8. So solve this, you'll get the answer. So this comes to 8 plus 5.6. We have solved it. So that comes to a total of 13.6. So that is our KE. So we'll substitute our KE here. KE is 13.6. That's a percent. So we'll solve our total answer. So the numerator comes to 0.2688 divided by 1.6%. So the total value comes to 16.8. But this is a per share value. This is a per share value. So we have to find out the value of the company. So how do you find out? You find out through the total number of shares, which is 4 lakh shares, multiplied by per share value, which is 16.8. You will get the total value of the company, 67 lakhs and 20,000, or $67.2 million. Okay. So as they're asking the market capitalization of the company, they're not asking the per share value, they're asking the full worth of the company. So this is the full worth of the company. So we'll again recap. So you have to fit in all the numbers here. If any number is missing, you have to find out that. Here we have found out G through the CAGR method, the compounded annual growth rate method, and we found the KE through the CAPM method. So that's how we have found the answer for this question. We'll move on to the next question. So we have another question here. A company has the following financial information available. Share capital in issue is 2 million shares at par value of 1. So the company has 2 million shares. The current dividend just paid is 18 cents. So this is the D0. The current EPS is 25 cents. The return on earned assets is 20%. equity beta is 1.1, and current market return is 12%, and RF is 5%. So again, if you look here, it's similar to the last problem. So we'll work out the formula. The formula is D0 into 1 plus G divided by KE minus G. So as per the formula, we have the D0. So the D0 is 18 cents. But the question asks you for the market capitalization of the company. So if you work out this formula, we'll only get the per share value. Okay. So then we have to multiply with the number of shares. So 18 cents into 1 plus G we don't know, as well as KE is not given. Again, G we don't know. So what happens here is we have to find these numbers and then we have to insert and get an answer. So we need to find out the G is the growth rate in dividend. Okay, that is what G is. So G, how do we find it out? We can't find it out through the CAGR method, but we can. He has given us DPS, he has given us EPS, and he has given us the rate of return. So use the Gordon method. So the Gordon formula says that the G equals to B into R. R is the rate of return on an asset. So that we have here. So we have the R, but we need to have the B. So retention ratio. What is retention ratio? Retention ratio is how much money has been retained. So it is EPS minus DPS divided by EPS into 100. So we'll substitute these numbers and we'll get the B. So EPS is 25 cents. And DPS is 18 cents. The answer comes to 28%. So now we'll find out the B into R. So the B comes to 28% and the R comes to 20%. So we'll get the G here. So the G will be 0.056, or if you express it in percentage, 0.056 into 100, then you will get an answer of 5.6%. Okay, so that is about the G. This is your G. So now we will find out the KE. So the KE works like this. KE we can find out through the CAPM. Again, RF plus beta into RM minus RF. So the RF comes to 5%. Beta comes to 1.1. RM comes to 12 and RF is 5. So we can find it out like this. So it comes to 7.7. So our answer is 12.7. So this is our KE. So our KE is 12.7 and G is 5.6. So this is 5.6 and this is 12.7. So we'll solve this. So the numerator will be 0.19 and our denominator will be 7.1%. So our answer comes to 2.67. But this is a per share value. We have to get the value of the entire company. So the value of company will be 2.67 per share into the total number of shares. Total number of shares is 2 million shares, 5.35 million. Okay, so we can get it like that. So that's about this problem. So how it works? First, we have to get all these numbers for the valuation of per share. So D0 was there, G is not there, K is not there. G we found out through Gordon model because the CAGR method cannot be applied for this question. KE we found out through CAPM. We substitute all the numbers and we got the value of the company. So that's about this question. We'll move on to the next question. So there's another method called as discounted cash flow basis. So these are the steps to find out the value of equity. To find out the value of equity, first you have to compute the free cash flow. So free cash flow is revenue minus all expenses less depreciation less tax. You will get the profit after tax. From there, less any capital expenditure and add the depreciation that was previously deducted. You will get the free cash flow. With this free cash flow, you can deduct it. You have to use the WACC to find out the value of the company. So you use the free cash flow divided by the WACC you will directly get the value of the company. But the problem is the value of the company includes the debt and equity. So what you here again do is you take the value of the company, deduct the value of debt, you will arrive at the value of equity. So this kind of deducting the debt is only for this problem. In no other problem you have to do this. So we'll move on to the problem. So we have a problem here. It says discounted cash flow based equity valuation. The following information has been taken from the SOPL and SOFP of a company. Revenue is 350, production expense is 210, administration expense is 24, tax allowable depreciation is 31, capital investment is 48, and corporate debt is 14 million, which is trading at 130%. Corporate tax is 30%, WACC is 16.6, and inflation is 6%. Okay, so these cash flows are expected to continue every year for the foreseeable future. So the same number is going to occur for a long number of years. Our job is to find out the value of equity. So we'll go as per the format which we saw earlier. So we'll start from the revenue. So the revenue is 350. So production expense is 210. Administration expense is 24. We have depreciation of 31. So that's what we have. We'll first deduct this. So this will give us profit before tax. So let's see how much it comes to, 85. From here we will deduct the tax. So the tax is at 30%. The tax comes to 25.5. PAT comes to 59.5. So we have got our profit after tax, but still we have few more steps. With the profit after tax, we have to deduct the capital expenditure of the company. So capital expenditure comes to 48. Okay, but we have to add back again the depreciation because that's what we saw in the format. So our tax allowable depreciation is 31. So we will see the answer. Free cash flow comes to 42.5. Okay, so the question is, this is the free cash flow. So what are the next steps that we have to do? So the next step is to find out the value of the company. So value of company. So the value of company is, if you take, it is the free cash flow divided by the WACC. It is a free cash flow divided by the WACC. So if you take the free cash flow, it is 42.5. But what about the WACC? The WACC has been already given as 16.6. Includes the inflation. So as the WACC is including the inflation, so that is an assumption. Okay, that's an assumption. Usually in the exam they will tell whether inflation is added or not, but here we will say that the inflation is added on to the WACC. Then we have to remove the inflation part because all these numbers are a 1 year number, so we cannot have inflation inside a WACC. We have to remove it. So how do we remove it? We have a formula for that. What is that formula? You might have remembered this formula. 1 plus I equals to 1 plus R into 1 plus H. That is, this refers to the 1 plus I is the nominal. So nominal is 16.6%. equals to 1 plus r, the real rate. That is what we want to find out. And and 1 plus h is the inflation rate, so that we know. So we'll solve this. So this becomes 1.166 1 plus r, and this becomes 1.06. So 1 plus r equals to 1.166 divided by 1.06. So 1 plus r equals to, so the answer comes to 1.1. It means 1.1 minus 1 equals to r. So the r should be 0.1, or if you represent as a percentage, it would become 10 percentage. So r here refers to 10. This is the WACC without inflation. Okay, so this is what we have to use in r as a denominator. If you use this as a denominator, the answer comes to 425. So now we have to find out the value of equity. So value of equity is the value of the company minus the value of debt. So what is the value of the debt? The value of the debt is 14 million, but it is stated at 130 percentage. So it means it is costlier than the 130. So if we solve it, we get 406.8. So this is the value of the company. Hope you have understood it. So we'll recap it again. Follow the sum as per the format. You will get the free cash flow. With this, you have to find out the free cash flow divided by WACC, because the assumption is the same number is going to continue for a foreseeable future. But the WACC are assumption, but or in the exam explicitly they will tell that this WACC includes the inflation. So we should not take the inflated value, because all these values are single year value. So we don't need to have inflation in our WACC. We have to remove it. To remove it, we did this, and we got our real discount factor, which is 10%. We took that number and we divided our value for the company, and we got the value of a company at 425. This 425 is for the company. We have to find out the value of the equity. So equity is 14 million. We can take that, but it is stated at 130% at a premium it is trading. So we are multiplying it by 130. We deduct it and we have found out the value of equity. So that's about this problem. So we'll move on to the next problem. So again, this is also a discounted cash flow problem. A company has annual after tax cash flows of 2 million per year, which are expected to continue in perpetuity. So they are going to keep on going in the same number. The company has a cost of equity of 10%, a before tax cost of debt at 5%, and then after tax weighted average cost of 8%. Corporation tax is 20%. What is the theoretical value of the company is asking. So which number should you take? Should you take the cost of equity, debt, or weighted average cost of capital? The answer is you cannot take the cost of equity. That does not work, because the value they have given here is the cash flow given is for the entire company. We can't take the debt value because there's no debt which is being played here. The only value that you can take is the after tax WACC, because this cash flow is also after tax and it's for the entire company. This WACC is also after tax, and WACC usually refers to the entire company. So our solution is like very simple. So the value of company equals to 2 million divided by 8%, and that will give us an answer that comes to 25 million. So now we'll move on to the valuation of preference shares. So valuation of preference shares is like very quite the valuation. So next we'll move on to the valuation of preference shares. The valuing of a preference share is like very easy. The value of preference share is P0 equals to dividend divided by the cost of preference share. So there are just like three numbers are involved. So the P0 is equal to a firm has a 12% preference share with a nominal value of $1. So 12% is the dividend rate and the value on which it is declared is 1. Currently the required rate is 14%. What is the value of preference share? So as the $1 is a single rate, okay, preference shares rate, the value that we'll get is also a single shares value. So when we solve this, we get 0.857. So that is the value of the preference share. Okay, so this is a per share value, not for the value for the entire company. So that's about the valuation of preference shares. We'll move on. So here we have come to the valuation of debt. So the valuation of debt has like different workings. So the first one is irredeemable debt. So it works like this. The market value of a irredeemable debt is interest before tax divided by KD before tax, or if you take, or else you can also work it like this. If it's going to be interest after tax, then your KD should also be after tax. So it is not that we are multiplying the number, okay? It's like representing interest if the numerator and the denominator should be like same. If the numerator is after tax, the denominator should also be after tax. If the numerator is before tax, the denominator should be before tax. Don't mix and match, then you won't get the answer. So we'll start with this company, valuation of irredeemable debt. A company has issued irredeemable loan notes with a coupon rate of 7%. If the required return of investors is 4%, what is the current market value of the debt? So again, we'll take it as P0. So again, this is in terms of per debt value or per loan note value. So the company is paying 7%, but we don't know on what nominal value it is being paid. So we'll assume that the nominal value is 1. If we assume the nominal value is 1, then we'll divide it by the KD. So we'll directly get the answer. So the value of a $1, okay, the nominal value $1 is being traded at 1.75. So that is the valuation of the irredeemable debt here. So we'll move on to the next problem, but this problem is not very good in understanding the before tax, the after tax, the nominal value. It's just to show you how the numbers are like divided. So we'll move on to redeemable debt. How does a redeemable debt being traded or being valued? See, here our work is like very simple. We have to take the interest and multiply all that interest before tax interest. It's very keen here, okay? You take all the interest before tax, multiply by the annuity factor and get a value. So the value is a present value. Then take the capital repayment or redemption value multiplied by that year's discount factor, you will get the present value. Add both the present values, you will get the value of redeemable debt. So the key part to remember here is the interest payment is before tax, okay? So this is like very, very important. So ensure that you remember it always. We'll move on. So we have a question here. A bond has a coupon rate of 8.5% per annum. The next interest payment will be made in 1 year's time. The bond will repay the par value of 100 when it matures in 7 years' time. Calculate the expected current market value of the bond if yields to maturity on similar bonds are 7%. So we'll try to solve it through a table. So in exam, you're not required to do a table and then solve it. Okay, only for teaching you, I'm doing this table format. Once you are like comfortable, then you can actually do it without a table. So we'll start. So we have two elements here. One is the interest element and the other one is the redemption value element. There are two elements here. So interest is paid for how many years? Interest is paid for the first year to the 7th year, and redemption is done on the 7th year. Okay. On cash flow, the interest that you are going to get is 8.5% on a 100 of nominal value. So you will be like getting how much of interest? Your interest will be 8.5 on a nominal value of 100. That is, you will be like getting 8.5 only. This is before tax. It's like very important. That is before tax. Okay. So if you want, I'll put it here. This is before tax. So remember that, before tax. And what is a discount factor? In the question, there will be two percentages. 1% is the coupon rate or interest rate on the bond. Okay, this is what the bond pays. But the market value in the for the interest, okay, the market yield or the yield to maturity that they will be mentioned. Okay, they will mention another percentage either in the name of yield to maturity. So that is the discount factor. So the discount factor in this sum is 7%. And at what value is the redemption is happening? The bond is redeemed at $100. Okay, so we have got two sets of numbers here. One is for the interest and the other one is for the redemption value. We have two sets of value. So we look at the annuity factor table. So here for this interest, we have to look at the annuity factor table, and for here we have to look at the discount factor table. So first we look at the annuity factor table for the interest. So we have to find out for 7% and for 7 years the number comes to 5.389, and for the redemption value for the 7% and 7 years we get 0.623. So we'll multiply the numbers. Number comes to 45.8 and this number comes to 62.3. So add both, that comes to 108.1. So this is the value of redeemable bond. Okay, so that the value is 108.1. So if you want, we'll explain it. So if you want, we'll explain it once more. So there are like two cash flows which are coming from the bond. One is the interest and the other one is the redemption value. Take the interest before tax. So that interest occurs for 7 years from first year to the 7th year. Redemption value occurs for only on the 7th year. Interest, you are going to get 8.5% on the bond. So the bond is going to be redeemed at $100. So the nominal value will also be $100 only. So on $100 compute the interest, that comes to 8.5, and the redemption is going to take place at $100. So you will take 100 as the cash flow. For the discount factor, you have to take the yield to maturity which will be given in the problem. So take that as a discount factor. So for 7 years, for 1 to 7 years at 7%, we have to look at the annuity table. So in annuity table, the number comes to 5.389, and there's a single, the redemption value is a single cash flow which is going to occur in the 7th year alone. So that will be for the 7th year 7% discount factor, the number comes to 0.623. So we have got the PV numbers here. We will add both and we got the value of redeemable bond. So that's about the valuation of redeemable bond. We'll move on. Now we'll move on to the valuation of convertible debt. So convertible debt is like very similar to the redeemable debt. The only difference is the convertible conversion option. So if you take the previous sum, redeemable debt, the only value that will change in the convertible debt is this value. Okay, because in convertible debt you have an option. What is the option? This can be either whichever is higher, okay, whichever is higher in terms of the redeemable value or the share value, whichever is higher you can take, and that will be substituted here. So apart from that, there's no other difference between the valuation of a redeemable debt and a convertible debt. So it's quite easier. The market value of a convertible is the higher of its value as a debt and its converted value. So whichever is higher you have to take, whether the redeemable value or the share value, whichever is higher you have to just pick that. So PICO has in issue 8% bond which are redeemable at a par value of 100. Okay, so if the par value is 100, then the nominal value will also be 100. In 3 years time, alternatively each bond may be converted into 30 ordinary shares of the company. The current share price of PICO is 3.3 and this is expected to grow at 5% per year for the foreseeable future. PICO has a cost of debt which is 6%. So this is the discount factor that we have to use. So now what we'll do, we'll first create the table for this. Again we'll do a table which is like very similar to the redeemable bond. Okay, so particulars, we have two items here. One is the interest and the other one is the uh, redemption value or the share value. So we don't know which will be the answer, so we'll write both. So here it is going to be interest is going to be paid for the first year to the third year, so 3 years. The cash flow is, it is an 8% bond and the nominal value is 100, so cash flow comes to 8. Discount factor is 6%, that is what is given here. The cost of debt is 6%, so we will take here. In a sum you will usually have two percentages. One is the interest percentage and the other one is the discount factor. If you can easily find out the interest, so once you have found out the interest percentage, the other number will be the discount factor. So that is about the interest. The redemption value is going to happen in which year? It's going to happen in the third year. What is going to be the cash flow? The cash flow is going to be, redemption value is 100 and share value is, we don't know, so this we have to compute. We have to look at the annuity factor table and this we have to look at the present value table. So annuity factor table number will be, for 6% for 3 years it is 2.673 and for the present value it is 0.84. Okay, so we have got the table. We can also find out the value of convertible debt easily. The only thing that we have to get is the share value. Okay, so for finding out the share value we'll do it here. So the expected share price in 3 year will be each share price is 3.3 into 1 plus, it's going to grow at 5% per year for 3 years. So this formula is nothing but the compounding formula. So we'll solve it. So it comes to 3.3 into 1.157. Each share is worth 3.82. Okay, so this is per share value. So what is the conversion value? The conversion value is each share is worth 3.82, but how many shares we will get when converted? Each bond will give us 30 shares. So 30 shares put together, we will get 114.6. So this is the conversion value. We'll take this there. We will get 114.6. So whichever is higher, we have to take. Out of these, we have to take whichever is higher. So whichever is higher is 114.6. So we'll take that as a basis and we'll get the answer. So the total value comes to 117.64. That is the value of convertible debt. So we got the first one, the market value. So second one is the floor value. So what is a floor value? So floor value is market value without the conversion option. So without the conversion option, what would be its value? So the conversion option is this one. So we'll try to work out that. So we are not going to have this option. We are only going to have the redeemable option. So we will take it like this. The redeemable option is 100 worth. So 100 multiplied by 0.84 comes to 84. So the value would be 105.38. So this is the value of the floor or straight debt. Okay, so without the conversion option, okay, this would be the value of a straight debt. So we have a last method to discuss, which is called as a conversion premium. So what is a conversion premium? Rather than buying a share, we are trying to buy a convertible bond. Okay, how much are we trying to pay for the convertible bond? So that is the question. So we'll solve it in the last. We'll solve it here. So conversion premium equals to the value of convertible bond minus the value of the share. So the value of a convertible bond that we found was 117.64 minus the value of shares. Each share is worth how much? Each share is worth 3.3, and we will get 30 shares in the future. But how much are we paying for additionally in terms of the share? So we would be like paying 18.64 as the premium. So rather than buying the share, how much extra we pay for the bond, convertible bond with the share option? We are paying 18.64 higher. Okay, so that is called as a conversion premium. So hope you have understood the problem. So thank you very much for watching this video. We'll meet in the next video.